Financial Reporting Through the Lens of a Property Casualty Actuary. Part 6. Differences from statutory to other financial or regulatory reporting frameworks in the U.S. Chapter 26. Taxation in the U.S. Beyond the solvency and general purpose financial reporting frameworks, taxation is another framework applicable to insurance companies. Taxation has many forms, including the direct taxation of the income of corporations. Generally, tax is imposed on net profits from business, net gains, and other income. The income subject to taxation is determined under accounting principles that are modified or replaced by tax law principles where a different basis is determined as necessary by the relevant taxing authorities. In the U.S., an insurance company is taxed based on its statutory income, but with adjustments provided by the Internal Revenue Code, or IRC, that will be described herein. Understanding the impact of federal taxation is important for insurance contract pricing, insurance company valuation, capital models construction, and tax returns preparation. Additionally, when there are changes to the tax law, it is important to understand the changes that occurred and the potential impact. In 2017, the Tax Cuts and Jobs Act of 2017, TCJA, which became effective beginning tax year 2018, changed key federal tax rules. The changes most significant to property casualty insurance carriers were related to the corporate tax rate, the discounting rules, and the international tax system. In this chapter, we will present a summary of how taxable income is derived for property casualty insurance companies from their statutory accounts, including a review of the adjustment of loss reserves for discounting. We will also review the process for determining taxable income attributable to statutory underwriting income and to investment income. Statutory underwriting income consists of premium revenue, i.e., earned premiums, minus losses and expenses incurred. Tax basis earned premiums. On a tax basis, earned premiums are adjusted for revenue offset. The need for the revenue offset stems from a lack of a deferred acquisition cost asset under statutory accounting. Assume that today a company wrote a policy effective January 1 of the following year for $100, but incurred $20 in acquisition costs. Under statutory accounting, the company would incur a $20 loss from establishing an unearned premium reserve of $100 and payment of $20 in acquisition costs. Rather than allowing property casualty insurance companies to claim a tax credit on that loss under statutory accounting, the IRC has established a revenue offset convention, often referred to as the 20% haircut. The revenue offset convention assumes that acquisition costs are 20% of net written premiums for all lines of property casualty business and all types of insurers, and requires that 20% of unearned premiums be currently included in earned premiums. In our example, the unearned premium reserve would be reduced by $20, resulting in the income effect from writing this contract as $0. Statutory earned premium is calculated as net written premium minus the change in the unearned premium reserve. Under the revenue offset convention, tax basis earned premiums are net written premium minus 80% of the change in unearned premium reserves. Tax basis earned premium equals net written premium minus the quantity 0.8 times the change in unearned premium reserve quantity. This formula can be arranged to provide tax basis earned premium equals statutory earned premium plus the quantity 0.2 times the change in unearned premium reserve quantity, where the change in unearned premium reserve equals the unearned premium reserve at the end of period minus the unearned premium reserve at the beginning of the period. Tax basis incurred losses and loss adjustment expenses. Statutory calendar year incurred losses are paid losses plus the change in full value loss reserves. Incurred losses equals paid losses plus the change in full value loss reserves. That's equal to paid losses plus full value loss reserves at the end of period minus full value loss reserves at beginning of period. For long-tailed lines of business, without the time value of money considerations that are considered in the pricing of policies, the result may be an underwriting loss under this statutory definition of incurred losses. As we previously discussed, the IRC does not provide an insurance company with a tax credit for what appears to be a temporary loss when investment income can be made on the reserves held before the claims are paid. To avoid this, tax basis accounting is more aligned with economic reality by requiring the discounting of loss reserves, albeit within defined rules and the lack of a risk margin or adjustment. Our next section will discuss the process of discounting for taxes in more detail. For now, it is sufficient to understand that tax basis incurred losses includes or equals paid losses plus the change in discounted reserves, or otherwise said, statutory incurred losses minus the change in reserve discount. Loss adjustment expenses are treated in the IRC in the same manner as losses, i.e., estimated loss adjustment expense is subject to discounting. Other kinds of expense liabilities are addressed in a different paragraph in the IRC and may be subject to a different timing requirement. Investment income. Taxable investment income consists of income from bonds, mortgages, real estate, and venture capital holdings, and realized capital gains. In addition, there are two key adjustments: proration of tax-exempt municipal bond interest and proration of dividends received deduction for stockholder dividends. Tax-exempt municipal bonds produce tax-free income for most taxpayers. Similarly, the dividends received deduction, DRD, allows most corporate taxpayers to reduce taxable income by a portion of dividends received from most other corporate taxpayers. Generally, earnings credited to the cash values of life insurance policies owned by corporate taxpayers are not recognized as current income. Insurance companies, however, are required under the IRC to include a portion of such tax-favored income and earnings in taxable income under a rule known as proration. For a property casualty insurer, proration increases taxable income by reducing the deduction for losses incurred by a percentage of such tax-favored income. Previously, the proration of rules required a property casualty insurance company to reduce its losses incurred deduction by an amount equal to 15% of the sum of its tax-exempt income, DRD, and any earnings credited to life insurance products owned. The TCJA amended the proration rules in a manner that retains the prior law's financial effect, i.e., a 15% reduction in the deduction from income tax at the top marginal rate of 35%, while reflecting the reduction of the top corporate marginal rate from 35% to 21%. It does so by replacing the reduction percentage of 15% under previous law with a reduction percentage computed by dividing 5.25%, the applicable percentage referred to in the statute, by the top corporate tax rate of 21%, which results in a reduction percentage of 25%. Should the top corporate tax rate change in future years, the proration rate will also change. Base erosion and anti-abuse tax, BEAT. Now that we have determined taxable income, we can establish the regular tax liability, which is 21% of taxable income, a decrease from 35% under the previous tax law. Yet that is not necessarily the end of the calculations. If a U.S. insurance company makes a payment to a related foreign company, it might be subject to the BEAT. In general, the BEAT calculations may apply when a domestic taxpayer, such as an insurance company, that is domiciled in the U.S., obtains a base erosion tax benefit as a result of making a base erosion payment to a related foreign party. BEAT applies when the insurance company is part of a U.S. group of companies that has average gross receipts in the past 3 years equal to or in excess of $500 million, and if base erosion payments constitute 3% or more of the total deductions taken by the U.S. group on its current tax return. The BEAT operates as a type of minimum tax that is added to the regular tax liability. It operates by ascertaining the modified taxable income of a U.S. taxpayer that has paid or incurred amounts to a foreign-related party that provide deductions from regular taxable income, or, in the case of reinsurance premiums, to a foreign reinsurer, reduce gross income included in regular taxable income. Generally, Modified taxable income is determined by adding back to regular taxable income the base erosion tax benefit caused by a base erosion payment. This minimum tax is equal to the excess of 1. BEAT rate times modified taxable income over 2. The regular tax liability. The BEAT rate in the 2018 tax year was 5%, moving to 10% in tax years 2019 through 2025, and then subsequently to 12.5%. The modified taxable income includes the income subject to the regular tax rate, plus all deductible or excludable payments made to a foreign affiliate, base erosion payments, for the year. Accordingly, to determine the BEAT charge, a corporation should perform the following steps. 1. Determine if subject to the BEAT. 2. Determine taxable income and compute regular tax of its U.S. companies. 3. Compute modified taxable income. 4. Apply the BEAT tax rate to modified taxable income. 5. Compare regular tax liability with the BEAT. As an example, assume there is a domestic insurance company that is part of a U.S. group that meets the minimum requirements for being subject to the BEAT. In the 2019 tax year, this U.S. subsidiary has 120 of gross written premiums for coverage effective January 1, and so no unearned premiums. $0 investment income, 0 losses incurred, and $10 of general and administrative expenses. Additionally, the U.S. subsidiary paid reinsurance premiums of $70 to a related foreign insurance company. The U.S. subsidiary regular tax must first be determined. Taxable income equals 120 gross written premium reduced by 70 of reinsurance premiums reduced by expenses of 10, which works out to $40. Regular tax equals 40 times 21%, or $840. Then the BEAT tax must be determined. Modified taxable income equals 40 plus 70 plus 110. BEAT tax equals 110 times 10%, which equals 11. As such, the additional tax due under the BEAT is $260. 11 minus $840. It is noted, however, that payments to a foreign company that has elected to be taxed as a U.S. taxpayer under Section 953D are not subject to the BEAT. Discounting loss reserves for taxes. In the section within Chapter 22, titled Deferred Tax Assets, we discussed the reasons why statutory loss reserves are discounted in calculating taxable income. We shall now look in more detail at the method prescribed under the IRC for determining the discount required. The discounted loss reserves are calculated using 3 components. 1. The undiscounted loss reserves. 2. The discount rate promulgated by the U.S. Treasury for that accident year. 3. The payment pattern. The first component is obtained from Schedule P Part 1. Reserves in Schedule P Part 1 are net of tabular discount, but gross of non-tabular discount. Therefore, any tabular discount will need to be eliminated to gross up the loss reserves from Schedule P Part 1 to an undiscounted basis. The discount rate will be determined by the U.S. Treasury for each accident year and is to be based on the corporate bond yield curve, effective for taxable years beginning after December 31, 2017. This is a change from the previous tax law, where the discount rate was determined for each accident year based on the 60-month average of the federal midterm rates. The payment pattern for each line of business is determined every 5 years by the IRS based on the paid loss development from Industry Aggregate Schedule P Part 1 data. Under the TCJA, insurance companies can no longer elect to use their own payment patterns. Additionally, during the transition from the previous tax law to the TCJA in tax year 2018, unpaid losses and loss adjustment expenses for all accident years were discounted using the interest rate and loss payment patterns applicable to accident year 2018. The recognition of the adjustment, differences in taxable reserve estimates between the prior methodology and the new methodology at the same point in time, from the interest rate and payment pattern changes are evenly spread across 8 tax years so that companies are not burdened with the full change in the first year in taxable income from a change in the tax reserve. Below is an example of an implied 8-year spread. TCJA impact. As discussed above, the TCJA had the following key changes affecting insurance companies: decrease in the corporate tax rate, repeal in the election for use of company-specific payment patterns, change in the determination of the interest rate, addition of the base erosion and anti-abuse tax, or BEAT. These changes will have varying impacts, with the biggest drivers being the primary exposures that are written, what payment patterns were used in the past, and whether or not the company utilizes an affiliated foreign entity for certain transactions, e.g., reinsurance.